Fund Alliance virtual roundtable on after the coronavirus, how will the landscape change for searchers? The Search Fund Alliance embodies the search fund ethos of collaboration and mutual support. It's the ethos of the search fund community. We all enjoy the returns, obviously, but the big thing is that we work together to help young people achieve these great outcomes. This roundtable grew out of conversations I had with several searchers that I'm working with. Myself being an aging baby boomer running a company through this whole mess and thinking, I'm exhausted, and when this is over, I'm going to be looking for somebody to run this company that's out behind me here. There's going to be great opportunities. And so I called Alex Temmel and talked it over with him and suggested that he lead this roundtable. He's uniquely qualified in a couple of ways. A, being leading search fund attorney who's been active in many search fund deals, but also because he's got extensive private equity experience going through the last recession. And some of the things that the private equity guys saw and what Alex saw are going to be very helpful and informative to searchers and investors in the search fund community. So without further ado, I'll turn it over to you, Alex, and take it away.
That sounds great, Hal. Thank you very much. So one, let's thank the Search Fund Alliance for putting this together. And April worked tirelessly to organize, I think it's now up to 180 RSVPs for this, which I will say when MK and Hal reached out to me, having hosted a few of these in the past, typically it's been 15 to 18 people in a live setting, and somehow I got roped into 180 via virtual Zoom calls, but I guess that is all of our new normals. What we wanted to do was put together a panel of folks who could talk about how the M&A process and the overall search community and world might change and evolve as a result of the COVID-19 situation. And as all of us have learned, whether you're living East Coast, West Coast, middle of the country, we all know how much our lives have changed. And the reality is that the acquisition process and running a company is going to be very different going forward. In some ways, it's going to remain the same as, in the past, there'll be challenges on closing deals, raising capital. Good deals are going to get funded no matter what the circumstance. The challenge may be to find those good deals and to match up with sellers who have made the determination that this is the right time to sell, and couple that with investors who like the opportunity and feel compelled to fund the acquisition itself and take advantage of the opportunities that are going to arise in the next 3, 6, 9, 12 months. None of us have a crystal ball in terms of what's going to happen in the future, but we've all seen, or at least I have seen, M&A activity slow down dramatically over the last 3 to 8 weeks. New deals have not been emerging. We've closed a number of deals that had started before kind of early March. But I do know that, at least from the private equity side of the equation, that interest has started to percolate again in terms of buying opportunities, and also hearing from folks who are looking to exit. I think Hal is not the only one out there who's probably a fatigued owner of a business at this stage. It's been a hard few months, and I think that is going to create some unique opportunities. We've put together a panel that many of the folks on the phone will have either worked with directly or know by name and reputation. And we tried intentionally to put together a diverse group of investors, long-time historical investors who have been through multiple waves of the economy, both recessions, hopefully not old enough for depressions, but maybe in some cases, but I'll let them answer that. And what I'd like to do is introduce our panelists and give them an opportunity to speak a little bit generally about this panel and what they've seen. So I'm going to start with Dave Carver. Dave's the co-founder of Search Fund Partners and has served on more than 30 boards. You know, when I saw that number, it felt like he was shorting himself because I've probably seen him be on 20 plus of those boards. But Dave, if you want to just say a few words and introduce yourself, I think that would be great.
Thanks, Alex. Good morning, afternoon, everyone. Thanks for having me on the panel. I'm Dave Carver. I'm along with Rich Kelly, started Search Fund Partners. We're not sure, it's been a long time ago. It's about 2004 though. We did have our 16th annual meeting of CEOs and searchers earlier this year, probably one of the last gatherings before the lockdown hit. But we've been investing in deals. I haven't kept track of how many, but it's well over 100 companies we've invested in and probably met several hundred searchers in that time frame. So happy to be on the panel and happy to participate.
Fantastic. Thank you, Dave. Next, Jeff Stevens, the founding partner of Anna Kappa, and also uniquely positioned as a former searcher, along with our master of data, you know, probably the most data-driven person I've met in the community. So Jeff, give you a chance to say hello.
Thanks, Alex. I hope that didn't set me up for a lot of failure today and not being able to come up with any numbers in this environment. Yeah, so Jeff Stevens, you know, as you said, you know, been really fortunate to be around the search community for 30 years now. Was lucky enough to be one of the first folks to partner with her back in 1990, which has painfully aged me tremendously, and have lived through this cycle multiple times. You know, when we were first searching in 1990, people won't remember what HLTs were, highly leveraged transactions. Banks were actually restricted in how much they could lend to companies. So we were living in that environment, went through the dot-com bubble, went through the dot-com burst, searched coming out of that, and then obviously have lived, you know, through the recession in 2008, 9, 10 as well with all of you. So hopefully can add a little bit of value through perspective on kind of what we've lived multiple times through this cycle over the next hour and a half.
Fantastic. Thanks, Jeff. Next on the list is Tom Cassett. Tom's the founder of TD Investment Capital, has done more than 140 investments during his career. And Tom, I'll let you say a few words.
Hi, everyone. So I'm the T of TD Investment Company. Along with my partner, Dave Lazier, we've invested in search fund companies over the last 30 years. And so seen a lot of changes during that time. We've also been owner-operators of generally manufacturing companies for the past 34 years. So look forward to talking with you all and giving you my perspective on what's going on.
Fantastic, thanks. Next panelist is Joe Niehaus. Joe's been with Housatonic Partners for more than 20 years, and I've actually been working with Joe for about that extended period. It kind of, when I looked at that date, aged myself tremendously. So Joe has a lot of background both in the PE world, lower mid-market world, and also in the search fund world specifically. So Joe, I'll let you say a few words.
Yeah, thanks, Alex. Nice to see everyone. Our firm deploys a bit of a hybrid approach to investing in searches. Most frequently, we invest our own capital, my partners and I, in searches, and my partner, Will Thorndike, who some of you know has been investing in searches for probably 30 some years at this point. And then for larger search transactions, we will consider those for our fund, our institutional fund. So we invest kind of two ways. And kind of happy to talk about what's going on in the world and how that might impact your searches right now.
Fantastic, thanks. And then our final panelist, who actually brings me joy because everybody else makes me feel as a 20+ year veteran, as a young kid, GJ, who has actually successfully searched and coming out of Stanford, and actually learned that he was a former basketball player at Brown. So that was a cool little unknown fact as I was looking into people's background. So GJ, if you could say a few words.
Yeah, that was definitely many years ago, but thank you for having me. It's an honor to be here. Obviously, a number of the fellow panelists have been mentors and people we've looked up to ourselves during our search, and a number of who were investors. So the quick background on us is Will Bressman and I graduated from a business school in 2010 and acquired RIA in a Box in 2011, which was a regulatory compliance services firm for small independent financial advisors. And Will and I ultimately sold that business as far as our search fund investors in 2018. But Will and I today continue to lead that business with the new private equity owner, and then also have over the last few years really ramped up a lot of our personal search fund investing. So it's an honor to be here, and thanks for having me, Alex.
Fantastic. So I think we're going to go right into the questions. And what we've set up is, I think it's 9 or 10 questions that we're going to work through, starting off kind of at a broader level and then drilling down into some of the specifics. Also, we've allocated about a half hour at the end of this presentation for Q&A. So if you do have questions, please feel free to submit those to April via, I believe, the chat room. And then April is going to pass them along to me. And if you are one of the lucky or unlucky folks, we'll actually read off your question. And depending on the quality of the question, we'll identify who it's coming from. So let's get started. Just broadly speaking, how do you think the landscape for searchers has changed as a result of COVID-19? And specifically kind of looking at it from a overall status of the economy and industries. Jeff, do you want to give us some initial thoughts on that point?
Sure. Start by saying, we obviously don't have crystal balls here, and I don't think any of us are PhD macroeconomists. So, we're guessing a little bit as much as everybody else, but have lived it a little bit in the past. Yeah, I think you'll find that everyone on this panel would suggest that we are either already in a recession or heading from this into a recession. That will be an extended recession. We don't know if it's 6 months, 12 months, longer. And the added complexity here, which is a painfully obvious statement, is that there was a jolt that created it that has actually impaired a number of businesses on a short-term basis beyond what we might expect to see through a recessionary process. I think if you look at a macro level and kind of ask, how has the landscape changed? I don't think we're going to tell you anything terribly insightful here, but in the short term, everything is going to get elongated in the process. Engagement with sellers will get elongated in terms of getting them to actually have conversations with you. Managing valuation expectations is going to get elongated because there's probably going to be gaps that have to get closed, and we'll get into that in a while. Diligence is going to be a much longer process than it has been in the past, probably for most companies, and probably take a deeper dive in areas that you might not have before, things like the stability and health of the customer base that the company serves. So I think you're going to see a much more elongated process. The other side of that story, though, is that, in the medium term, we actually will enter what we have said for decades is the best time to be searching. I think search works through any phase of a cycle, but the best time to be searching is coming out of a correction. You get a chance to have a little bit of rationalization in the market in terms of seller expectations. Debt goes away, it starts to come back a little bit, and you get to see businesses perform through the cycle and have a much better sense for how stable and predictable they are. So, while the near term, we don't know if it's 3 months, 6 months, what have you, will probably be difficult for most people to manage. Our argument is going to be that you're going to actually get the benefit on the back end of coming into a phenomenal cycle. And just back to data, 2 quick points for you. I think if you look at the history of search, and the numbers were obviously much smaller historically than they are today, the cohort of search deals that were businesses that were acquired in 2002, 2003, coming out of the dot-com bubble, is probably the single best group of deals done in this community in sort of succession. You had Service Source, you had Southern California Risk Management, you had Pro Service Hawaii at the tail end of that window. 3 of maybe the top 5 or 6 deals ever done in the search community. Anacapa was formed in 2010. Dumb luck that we kind of formed as we were starting to come out of this, so we take no credit for it. But the first 4 businesses that we invested in at the tail end of 2010 and first part of 2011 produced 9 times the money, 8 times the money, 4 times the money in 26 months, and then 1 deal that hasn't done as well. And I would argue that was more a management issue than a quality of business issue. So I think that you're going to be coming into a window where the probability of getting a good deal done and having a great outcome is going to increase dramatically. You just got to get there.
That's great. Thank you. GJ, as someone who kind of emerged from B school coming right out of the 08, 09 perspective, any thoughts on how this COVID-19 world feels like or looks like what you saw back then, and lessons that you think you learned from that?
Sure. I mean, I would echo a lot of what Jeff just alluded to there. I would say, look, I mean, just to call a spade, look, it's hard out there right now, right? I mean, this is tough. I don't want to sugarcoat it. Like, this is tough to be a searcher right now. We all know that. We can kind of dance around that. It's going to be hard to get a deal done the next few months, to kind of echo Jeff. But there are some inklings of things happening. We have, 3 searchers getting LOIs done this week. There is starting to be a little more activity. We're starting to see a little bit of this. But look, it's going to be hard. To maybe reference some data points too, and I always get a bit nervous referencing data with Jeff around as well, because he may have better data on this, but actually Dan Dowd, who I know some of you know, who's about to embark on his own searching, actually maybe on here today, he pulled together some data I thought was very helpful during the last downturn of kind of average search duration, number of searchers, things like that. And look, to Jeff's point, we don't have perfect data back then, it was smaller sample sizes, so I think it's more directionally interesting to look at. But we saw for search funds formed in 2008, I believe when he cut the data, the average search duration increased to 2.7 years. That was the average time it took to find a company to acquire. Before then, it was right around 2.1. And again, looking not at exact data, but long way of saying that searchers took an average of, call it 6 to 9 months longer on average to find a deal. And if you look at actual deals done, again, it's not perfect data. There were 6 deals done in 2008, 10 in 2009, 12 in 2010, and then 15 in 2011 is actually when we acquired our business. So to echo Jeff, like, look, I think the big thing here, I think you'll know this, is finding ways to extend your runway are going to be really important, because we believe genuinely that there's going to be a great opportunity to buy businesses, and trying to find a way to kind of quote unquote be in the market when this market does turn around a bit is just really, really valuable. And you have the chance to get lucky on timing. And Will and I would probably be the first to admit that we got very fortunate on the timing. We bought a business in 2011, we sold in 2018, to echo kind of Jeff's vintage statement. Like we were great beneficiaries of timing, undoubtedly. I guess I'd also just bucket searchers into 2 buckets. Look, if you just started searching right now, I think you're actually very fortunate, and you actually have a chance to get very lucky on timing here. Look, who knows how long this lasts? None of us know, but you may have a chance to kind of, hit the kind of prime of your search year 2, where you've got a little bit of things open up a bit. You have a chance to buy a great business at a reasonable price and all those things. Look, if you're in your latter half of your search right now, month 16, month 18, look, this is hard. I don't think we want to sugarcoat that. But look, I think Andrew Saltoons actually put out some good things about this as well. Like, he talked a lot about searching during the downturn, of really focusing on quality deals. Look, it's easy to get distracted right now. You see a company is down 50%, it's for sale. You can buy it for 3 times, and but really focusing on quality, because it's gonna be hard to get those deals done that aren't high quality. I do think the bar will go up to get a deal done. So those are just some things, we think about it as we look at and kind of react at the past a little bit.
Excellent, thank you. Joe, from your perspective, looking at the 2 time periods of what we're staring at today with COVID-19 and coming out of the recession, from a broader M&A perspective, given your PE background, any specific thoughts on how you expect this to kind of play out in the short term, near term, et cetera, et cetera?
Sure. So, I mean, what I would say is none of us have a crystal ball in terms of the severity and the duration of the recession, but what we're telling our CEOs, and I think you guys should kind of bear this in mind as you look at businesses, is you ought to expect a pretty lengthy downturn and a slow recovery. Now, hopefully it'll be better than that, but no one really knows, but I think that's what you ought to be prepared for. And I think in the short term, there'll be a slowdown of private equity activity, which may present more of an opportunity for searchers. Although the private equity activity will bounce back once firms kind of feel like they have a handle on their own portfolio companies. A lot of private equity firms are focused on managing the health of their portfolio companies right now, and less so on new acquisitions. I do think we'll see overall a slowdown in transaction volume for 6 or 9 months or more, and it was more in the last recession, the 08-09 recession was more than 6 or 9 months. That doesn't mean there won't be any transactions, and GJ just gave you some stats, but it's going to be slower. And I will tell you that industries that have been more severely impacted will not solicit much investor interest until their path to recovery has been more established. That doesn't mean you ought to wait until they're all the way back, but until you see a pretty clear trajectory that they're going to come back. when we look at our own portfolio of 20 some companies, we bucket those into those that have been either not impact or have benefited, those that have been modestly impacting, revenue down 0 to 20%, and those that have been severely impacted, where revenue is down 50% or more. And I echo GJ's point. I just think while those might look enticing, I don't think your investors are going to be excited to take that risk on the severely impacted companies until there's more of there's more data that they'll ultimately be able to return to a normal level of revenue within some foreseeable period of time.
Fantastic. So Tom, what are your thoughts on, how you compare the two time periods, and if there's anything specific coming out of this, supposed reopening that maybe is slower depending on what region of the country you're in?
Sure. I'm not smart enough to know how analogous the period following 2008 is going to be to this post-COVID period. But I do believe that there's likely to be some parallels. To be honest, we had a lot of good searchers looking for companies at the end of 2008 and 2009. And for a solid 12 months following the post-Lehman bankruptcy, none of our searchers had closed an acquisition. Now, this could be different. One of our searchers actually closed an acquisition earlier this month. And so, this time around could be different. But I think, as has been said, the acquisitions that were done after that year period in 2010 and 2011 were some of the very strongest results that we've seen over the 30 years that we've been investing in search funds. And I think it takes a little bit of time for sellers to ratchet down, their expectations of what their business is worth. And I think another, certainly in 2008, 2009, that the financial crisis led to a severe retrenching from banks. Banks essentially were doing very little financing of acquisitions. My guess is, we're going to see some retrenching from banks this time, maybe not as bad as 12 years ago. But I think the search fund model maybe can take advantage of that. In that, I think often I think search fund investors are in a position to help fund deals without bank debt. I think there's also in 2008, 2009 we saw some really good businesses that face some liquidity pressure, and that created opportunity that isn't usually there. And so I think the opportunity to acquire a really good business is greater. And I think there's also likely to be less competition from private equity firms. The advantage of being a new searcher is you don't have an existing portfolio that you have to manage and take care of and make sure they're taking steps to keep on going, but you get to start fresh. And so I think that's an advantage. And then one other advantage is we're going to see, like we did in 2008, a much higher rate of unemployment. And with many of our companies, the greatest constraining resource over the past decade has been the ability to bring in good people. And so I think we're going to have that opportunity, that there's going to be good people out there available for work to help grow the companies once you do your acquisition.
Fantastic, thank you. One of the areas that I think is fascinating about the search fund world relative to the private equity world that I also live in is the diversity of the types of investors that you have, the what I'll call institutional investors, you have family offices, you have individuals. And I'm curious what the group thinks in terms of how this experience with COVID-19 might impact investor psychology as you guys look at potential new investments, and also recognizing that you have existing portfolio companies that may have cash needs. And while we all want to be acquiring companies at the lowest price, there's going to be a balancing of that. Jeff, have you guys started thinking about how you're going to allocate funds both across existing platforms and then your new potential investments? And do you ever think about kind of dry powder, or is that not something that drives your investment decisions?
So I think we don't think about dry powder in the same vein as the broader markets. Rightly, wrongly, we would tell you we're not capital deployers. We think of ourselves as operators that love to get involved with these businesses and happen to be deploying capital in the process. I think that's different than many aspects of the broader private equity market that are really driven by pushing capital out, getting fees on it, getting more capital in to get fees on it. And at the end of the market we operate in, the size of the funds we operate in, we don't make money off of fees. We make money off of carry. So we're really highly aligned with the entrepreneurs and motivated to get good deals done that we can drive over an extended period of time. With that said, we were actually getting ready to head back into the market this year to raise more capital. And I think while we won't do it right now, it's probably not the best time to be in the market. I think we are highly sensitized to making sure that we have plenty of capital available, given what we're all telling you is our view of, I don't want to call it a bubble, but an expanded market of great deals that are going to come to the search community in the next 6, 12, 24 months. So we definitely want to make sure we're in a position to take advantage of that and support the entrepreneurs that we're partnered with, and I have no doubt we will. I don't know if you want to talk more about psychology of investors beyond capital, but that's the answer to the dry powder question.
Yeah, I think, Jeff, probably we're spending a couple moments on whether these events will change what you're looking for in an investment and the types of features that you might view as a positive or a driver.
Yeah, so I'll speak for Anacapa, but I suspect this is going to be to the broader community. And again, I think you probably watched it in 2009, 10, 11 as well. When you go through a correction, when you go through a period with a lot of sort of tumultuous events for companies, there's a natural gravitation to the core, to the elements that drove the model in the first place. So I think you'll see amongst all investors, not just Anacapa, even more emphasis on the core attributes of the search model itself: stability, predictability, and cash generation. Businesses that generate cash, that is a core element of the search model, always has been. Cash is king. We'll talk a little bit more about it later. We held a webinar yesterday with 4 lenders to the search community to talk about how they're thinking about the current environment and their willingness to lend. And they spent a lot of time talking about the importance of cash and the difficulty in knowing what cash is going to look like given the current events, but how important that's going to be. So I think you're going to see a lot more sort of retrenchment to the core attributes of the model and less willingness to take a flyer, so to speak, on a business that might have really interesting run rate, but doesn't have the predictability. I think number 2, time to gain comfort with the company and the industry that it plays in is going to be longer. We talked about that earlier, but you not only have to understand what happened to the company through this process and how that might project out, but there's going to be more emphasis on what's happening to the customers that the company serves. And what's the underlying nature of what's happening to the industries that company ultimately plays in, retail, real estate, tech, et cetera. So I think you're going to see an extended amount of time necessary to get comfort around what's happening on a broader diligence process. And then I think ultimately you'll see more structuring in deals, which I think we'll talk about later, to try to protect against downside of lack of certainty around how these businesses are managing. But I'll echo, I can't remember who said it earlier, good deals are going to get funded, and they're going to get funded all day long. So you find a good business that fits the core characteristics, and I think you're going to have no problem raising capital to get it done.
Joe, from your perspective, given that you see the range of deals, both smaller and larger in this space, what are your overall views of what are the investment attributes and thoughts and overall psychology of how you're approaching this from a pure investor side?
So maybe speak about the higher end of the market first, the kind of private equity side of it. I think, as I said earlier, I think many private equity firms will be distracted by managing the health of their existing portfolio companies. There are others, us included, that are trying to take advantage of this market. And we've actually signed, I think, 2 companies under LOI since the shelter-in-place orders went into effect. But those were companies we'd been having discussions with prior to that. We are not yet certain how likely the banks will be to lend until we see more evidence of a recovery. So that's something we'll figure out in the next couple months. But I think that will lead to a slowdown at the larger end of the market, the institutional end of the market. And I agree that those types of investors, the PE firms and their investors, will be more cautious in trying to understand, as Jeff mentioned, the broader impact of what everyone working at home for 3 to 6, or if you're in New York, you might work at home for 9 months this year, are going to have on several business models. I think the search market, in contrast, is honestly in a better position because your capital is generally high net worth investors, family offices, and people like Dave and Jeff who represent those types of investors. And I think they're willing to be more nimble, and they're going to be willing to invest for attractive opportunities for good companies. Having said that, I think you should expect less debt, and therefore, we will talk about this a bit later. There's going to be more structure, including more seller paper. So I think, in contrasting the two, the search funds are in a better position than the private equity firms are right now because of the nature of their investor base. Now, not all high net worth investors maybe feel that way, but I think most of the investors that I know in the search community have sufficient dry powder to kind of strike while the iron's hot here.
Yeah, thanks. And for what it's worth, I'm going to echo that in terms of what I'm seeing in the marketplace. My private equity investors are honestly spending all of their time right now managing their existing portfolios. And they are not out in the marketplace looking for new investments. Again, it feels like, one of the interesting things that all of us on the panel can bring a little kind of perspective to is, I know the last 2.5, 3 months have been extremely painful for everybody, but it's actually kind of hard to remember it's only been 3 months. And it's really been 2 months since we've been shut down. That feels like eternity, but in terms of looking at an overall cycle, we're still at the nascent stages of this, and figuring out what this is going to impact and what it's not is really an unknown at this stage. But rest assured that most of the private equity firms that move into this lower mid-market are not out there doing acquisitions. So it's not as though this group of searchers is on the sideline and other people are cherry picking opportunities. Everybody is positioned the way you are, trying to figure out how it's going to sort out, and nobody has a crystal ball. In fact, I would say 90% of the private equity world right now is spending 70 hours a week trying to figure out PPP loans for their portfolio companies and what level of risk and reputation they're under. So it's going to play out. I guess, Tom, what are your views from an investor perspective, given that you fit into a different place than some of the more institutional investors in terms of the capital that you're putting out there? And what's your overall view of this marketplace right now?
Sure. My view is that, individual investors and search fund investors in general have really gone through a decade of prosperity, and in general, they're pretty liquid, and they're eager to invest in good opportunities. And, I think they're going to continue to look at the traditional kind of search fund attributes and looking for those attributes in potential acquisitions, a high degree of recurring revenue, high gross margins. But at the same time, investors from now on are going to kind of be looking at any acquisition opportunity kind of through a post-COVID lens. I think investors will think, well, gosh, if we have another virus 3-5 years from now, how will this firm be affected? Is this a firm that has demonstrated an ability to work, where people can work remotely? Is this a firm with an innovation culture? So, I think the the world has changed, I think, and that this will always be some investors are thinking of.
Perfect. GJ, as the youthful voice on the panel and also someone investing, essentially your own capital in most ways, how has your perspective changed and overall view, both investor and former searcher?
Look, it's a good question. I think a lot of this has been hit on. I think maybe to somewhat indirectly answer your question, look, we're undoubtedly going through dramatic change in our world right now. None of us know what that means ultimately, and Will and I are kind of living this firsthand, still running a business, like a few of you echoed earlier as well. Look, I think I got to take a step back. This is an incredible change happened to our economy. That's maybe the greatest change that happens to all of us during our lifetimes. That's scary, but also is an incredible opportunity. And there's a lot of, I think, parallels to the last economic downturn in 08, 09 to kind of reference. And what I mean by that is, look, like take our business. Like we're fortunate right now. We're actually hiring right now. Our business is doing well. There's very different stories playing out. I think the media, it's easy to kind of just follow all the carnage. And look, the carnage is real. It's a tragic time in our society, but there are a lot of businesses actually doing pretty well right now when you start to unpeel the orange a bit. Take an example. When we did our search in 2010, 2011, we had 6 deals under LOI throughout our search. All 6 of those companies did very well during 08 and 09. I think we were shocked how many businesses we came across during our search. It actually fared quite well during that time. So I think you really want to get very focused on industries here. I think industries matter a lot. Like take, for example, we're going to be working from home more. I mean, we're dealing with this as a company right now. We've got 80 employees right now that are just waiting for us to basically go to a total work from home environment. I'm not sure we're going to get there. I'm not sure how this all plays out, but that's a dramatic change. It's going to have huge dramatic change across so many industries. There's going to be so many opportunities that come out of that for you to think about these niche industries that are going to change, benefit from this, maybe a little bit, when you unpeel the onion a bit further. Like when we thought about, we were a very thematic industry-driven searchers during our time. And we actually looked at the financial crisis and we kind of looked at it head on. It's like, all right, what's changing on this financial crisis? And it was clear that like the financial services world was going to change. So we actually targeted financial services quite a bit. And when you kind of put all that together, I think you're going to see some incredible industry opportunities. I think that's going to tie back to what people are interested in investing in. Is you're going to really have to be tied in your industry theme of why this business, to Tom's point, is positioned to kind of survive the next few years if we have more challenges with this. And also really having a thesis about the long term, because we're big believers that industry ultimately always wins. And I think we're going to see that even more so going forward in the coming years here.
Perfect, thanks. I was planning on putting some of the participant questions at the end, but I've actually seen 7 questions that overlap with one of the next ones that were actually on our list. And Jeff, I'm going to go to you with this one because you'll get the benefit of answering maybe the hardest question that we're going to ask is, are there any industries that you view as off limits, better, worse, and can it be answered yet? I'll give you the lawyer's ability to get out of the question by not really answering it. Or is it too soon? But are there areas that you think, the search industry is just gonna, or would be well advised to take a step back from and or focus on, or is it too early to tell?
Yeah, I mean, the easy answer is that last statement, and there's an element of that for sure. There are definitely components that are a little bit early to tell. I mean, I'll make 2 broad-based statements. One, I think we have a reputation, within this community for being extremely disciplined around the core of the model. And, we're going to say that's even more important now than ever. I don't know whether everyone's going to completely align with that. So the predictable, industries that have predictable revenue, industries that have, absolute ability to define what the demand drivers are. Is this a need versus a nice to have service? The ability to gain comfort, like I said earlier, around the underlying business model of the customers and what could happen to them. And that's going to be very much too early to tell. I can give you one example. We have a deal under LOI with one of our searchers right now in the commercial landscaping space. And, I think that that's a basic need that, will continue, but what's going to happen to the underlying commercial real estate market? To GJ's point earlier, if more and more companies go to a work from home environment and there's less total office space needed, I'm not in a position yet today to say that is unequivocally going to happen or enough to have a major impact on commercial landscaping, but it's certainly a big question that I think have to figure out how to answer. So I think that you've got, those elements to it. And then, obviously growth drivers, Tom said it, GJ said it, what are the characteristics of the industry underneath? that are going to ultimately matter most. I think we're going to be in a position where we're not going to retrench per se. You know, maybe some investors, like I said earlier, will move back to the core attributes. I think we've just always lived there, for better and worse. You know, but that's always how we've managed, is let's find businesses that are highly predictable. And I think you see it, you know, Joe said earlier that the search community is probably a little bit better positioned. I can't speak to everybody in their portfolios, but you know, we've got 30 operating companies right now, and we have, I would say, 3 that have significant impairment, and 2 of the 3 are, I mean, all 3, but really 2 of the 3 are almost entirely driven by a variable that we never considered in diligence, which was the lack of ability of a customer to get to you physically. You know, an ophthalmology and optometry practice we don't think of as a you know, a cyclical business that's going to have high impact from a recessionary environment, and yet, you know, the customers can't physically get to them, and it's not an essential service other than emergency, and so their business is way off. We don't worry about that longer term. Those are variables that I don't think we're going to have to, you know, try to factor into diligence longer term. We're not going to model that for the next 10 years. Every 6 months, we're going to go through a period where customers can't get to us. But, you know, that's the nature of kind of the portfolio that we live in. We feel pretty good about it right now.
Dave, how about you? What kinds of, from your perspective, industries to favor, disfavor, or is it too early to tell, too challenging to try and pick in that perspective relative to a pandemic like this one?
Yeah, you know, we keep going back to 2008 to try to find parallels, and I think there probably are some. I think there's an argument that this experience won't be as long lasting as the last big recession, and that might be favorable for searchers because you'll be able to see more quickly people coming out of this in a strong position. And as far as industries go, there's probably some obvious ones like airlines and real estate and retail, at least retail with real estate that you want to avoid. That's probably not something new though. I think, but we have, you know, we just did a deal in the events management space. And you think, why would somebody invest today in a business that depends on large gatherings of people? But we think there's a case here that that virtual meetings will be a growing trend in that subsegment, and so we think there's good possibilities for this business, and that's probably where people are going to find success in the next year or two. It may be in a traditional business, but that's got an underlying segment and our underlying trend that's positive, and I think that's a benefit for a searcher if you have time to observe some of these things and find some of these niches where there is a positive trend, then that might lead to some good deals.
You know, Dave, one of the things that's interesting, I'm going to switch gears on us a little bit away from the investor side of the equation and the searcher side of the equation, but more to the sellers themselves. And one of the challenges of a pandemic like this one that maybe is a little bit different, honestly, than the recession in the 08-09 period is trying to figure out the mindset of sellers through this. You know, we heard Hal reference before that he's a tired operator at this stage and would be looking for an exit. I know he said it in jest, but there's always some truth behind any statement like that. Do you have a sense of where psychology may land for business owners, and whether we think it's going to be unique to finding the right person? It's too hard to put a broad brush as to whether people are going to be fatigued, how it's going to affect valuations, et cetera, but some overall thoughts on the seller side of the equation, because we have to find a willing seller to affect an acquisition.
Yes, obviously a key, and it's always been a challenge in the search fund world, probably more so today, because I think there actually are probably some sellers or business owners that have time today and would like to entertain the possibility of a liquidity event. And there might be a lot more tire kicking than there has been in the past. So that's, I think that's a risk for searchers, especially proprietary searches, who we're going to have to be smart in figuring out whether or not you really have a motivated seller or not. You know, we used to hear in the 08, 09 timeframe, people were ready to sell, but they didn't have an alternative. They didn't know where to put their money if they did have a liquidity event. So that might bear looking into if you're a searcher. You know, it's the age-old issue of can we really assess the motivation of a seller? So I don't have any easy answers to this one, but I think that's part of what is going to be a bigger challenge for searchers. If I'm guessing that the broker channel is probably going to be drying up just like the other ones are. So no easy answers there.
Yep. Joe, from your perspective, what's your expectation as you think about sellers in the marketplace, whether they're going to be anxious to sell, are going to view this as a downturn, better to hold? Any sense of, if you had the crystal ball, where you think it's going to go, or is it too hard to tell?
So what we saw 10 years ago was a bifurcation of the universe of sellers into those that became extremely motivated to those that felt like, you know what, this is a rough patch for the economy. We're just going to wait, and I'm not going to take a discount to sell my company in the near term, and I'd rather wait a year or two and then re-engage with prospective buyers at that point. So the motivated sellers, I think, are either kind of later in their career. They're older people who feel like, you know, life's too short to have to live through another one of these things, and they've made enough money, and it's just, you know, time to go to the beach. Or someone who's maybe not at that point in their career, but 95% of their net worth is tied up in their business, and they just saw it take a big hit, and their mind shift change, their mind mentality changes from maximizing net worth to preservation of net worth. And if you can find somebody like that, I think you can cut a pretty interesting transaction in this environment. And then I accept Dave's point where they're not probably going to tell you that on your first meeting, and it'll take some time to kind of ferret that out. But there will be a group of sellers here that are highly motivated to transact in the near term if you can find them.
Joe, what do you think, following up on that? And it's really interesting. Obviously, if you find a motivated seller, that's self-fulfilling and that's easy. If you encounter a business that you like and you potentially have a seller that's in that second category, just from thinking back about it, and we all have limited time to dedicate to an acquisition, and you have to make the decision, do you focus on it, do you move on? Just experience-wise, do you have a sense of how often when you have that unmotivated seller and you think there's an opportunity, you actually turn them into a motivated seller? Or is the reality that once they're there, moving them is really challenging?
Well, I think what you could do is try to engage in a discussion on valuation earlier in your process, getting to know them. And if I have a business that's been impacted, say in that middle bucket where it's down 10 or 20%, and I might feel like valuation multiples are down too, so my overall value is down more than just the decline in the cash flow. But if you tell them that, you know, you'd be willing to pay something that's less than what the business was worth 6 months ago, it still might be enough in their mind to think, well, maybe it hasn't been impacted as much as I thought. Because, you know, most of these industries will come back, not all, but most of these industries will come back after some period of time. And one can engage them in what kind of that top line number is. If that's enough to kind of pique their interest, then you can talk about structure and what the components of your bid entail. And I know we're going to get to that, Alex, but there's lots of ways to kind of skin the cat if you have a top line number and they have some flexibility in terms of how much is cash and how much is something else.
Jeff, from your perspective, as we talk about, you know, those sellers who aren't immediately on the board ready to go out, thoughts on things that we can do to maximize, you know, the opportunities and getting them over the line of really contemplating a sale, whether it's via structure, speed, or what you've seen kind of work to get people across that line?
Yeah, I mean, I directionally probably agree with everything Joe just said. I mean, you know, at the end of the day, I think this will come back to time. You know, there will be a meaningful block of owners that are interested in having a conversation, but not at the right time. We live this in every phase of the search, not just the current environment, but it gets exacerbated in the current environment. So, I mean, what Dave said, without question, understanding the motivation of your seller, understanding what is driving them either to sell or not to sell in the current environment, so you know what you're working with and against, and trying to figure out the problems that you want to solve is really important. It's important all the time in search, but I think it's a heightened importance now to absolutely understand what's driving the seller in their thinking in the current environment. I would argue also that it's worth trying to develop relationships with folks with a longer mentality. We've said that search is going to get extended in this environment. Apply that and make that actually something that you can work to your advantage rather than it becoming a pressure point for you. Be willing to engage with sellers knowing that you might not be able to get this to the finish line for 6 or 12 months, but you've got to find a way to extend your search and your runway to have the opportunity to have that conversation. And then the last piece from a structuring standpoint that I would say is, a lot, like you said, a lot of the sellers that are probably at a place where they're contemplating a conversation but not really sure are wondering whether or not it's too early and whether they're leaving too much money on the table, but they really don't have the energy to grind their way through this process. And allowing a seller to roll equity, get enough off the table to give them the opportunity to actually have a meaningfully good lifestyle outside of this, but have the potential to continue to ride the business and the opportunity for the business with you doing all the work. I mean, it's kind of a free play. Obviously, they've got capital in the game. I think is a great way to do it. And we've had, and I'm sure everyone on this panel can talk about this, we've had some great successes where, sellers rolled capital and ended up making as much, if not more, with a fraction of the ownership of the business under our collective management than they did when they sold it to us.
Tom, what do you see from your perspective as you hear kind of the brainstorming going around? Any additional reactions or thoughts on the seller psychology angle?
Sure. As we've talked, it's going to take a while for many sellers to ratchet down their expectations of the valuation of the business, and so it's important, I think, for existing searchers to think about, what can I do to extend my runway? Is there something I can do to slow down my burn rate of my cash? Can I, if I run out of money, have I established a good enough rapport with my investors that I could possibly go and ask them for some additional search money to extend my search? And then, I agree, there's going to be a certain subset of sellers that thought they had a very stable business that couldn't be impacted by anything. And this COVID has had an impact on their business. And so fear can be a great motivator. And as Jeff mentioned, allowing sellers to roll over equity can be a great way to get a deal done. Perhaps using earnouts to bridge the difference between what the seller's expectation is and what the market value is can be important. I also urge searchers to, as has been mentioned, to have patience. And whenever you're dealing with a seller, even if you're not able to bridge that valuation difference, don't burn the bridge. Let the seller know that you're still interested in their business, and if things should change, you want them to reach out to you. And something we did see in 2008, 2009 is that there was that deals that went away would come back several months later. And so important to keep those lines of communication open.
Tom, I think that's a great point. And one of the realities that I'll bring from the perspective of the private equity world that fits into the search world, that 08-09 period actually changed the way many private equity firms source deals. And the firms that had internal sourcing capabilities that reached out and stayed in contact with targets ended up being very successful. So similar to what you're saying is, if you can't bridge a valuation gap at a given point in time, that doesn't mean that that's not a seller who wants to sell. It just means at that point in time, the right terms aren't there for both sides. And I would encourage all of you to take the long view of it. And, you know, what's interesting about that is under normal circumstances, and for those of you who have worked with me on your actual search, one of the things I give people advice is try and figure out very early on whether there's a potential deal. And if there isn't, move on, because you have limited resources and limited time. This is actually an era where I think that advice, frankly, does not hold up as well, because deals will circle back and seller psychologies will change. And it might be as a result of a health issue. It might be as a result of them watching a friend get sick or struggle financially. We have no ability to predict who's going to come back. So for all of you who are in the middle of sourcing deals or spoke to people 3 months ago that were not interested, circle back. There's nothing wrong with revisiting those networks, and whether they're a potential seller or not, they may have a colleague or a friend who may be. So my suggestion to everybody would take that long run and be patient, because it is going to take additional time. And I think everybody has pointed out it's incumbent on all the searchers to manage their fund to maximize their searching time and searching window, because deals will take longer. But sometimes those sellers who were not apparently able and willing to sell will suddenly change. And you want to be there because you have already established a relationship, and rekindling that relationship may actually be much easier than establishing a new one. You know,
Alex,
one of the,
can I just
yeah.
add one thing to that? You know, I think, you know, a lot of you are going to feel inefficient in the short term. You're doing some outreach, you're not getting a lot of response, you're trying to figure out how to fill your time, maybe you're doing industry research, what have you. You know, with sellers that are business owners that are willing to engage, but it's not the right time, if you can figure out a way to help them a little bit, you know, spend a day or two working on something for them where they just don't have the bandwidth or the knowledge to try to solve a problem in their business, you not only create goodwill and a deeper relationship, but you get to know the business a little bit better through that process as well, because you're probably getting information to support them. It's not always going to work, but when those opportunities come up, I would say take full advantage of them. It's not a bad use of your time, and you're not really delaying your search meaningfully in the current environment.
Yeah, that's a great thought. One of the specific things that I've had a few questions pop up relates to what our expectations are with respect to valuations. And are they by definition going to drop as a result of this? What I found most interesting about the 08-09 period, and probably the most challenging part of closing both acquisitions and investments, there was a very significant lag between sellers' realistic views of valuations and buyers' valuation. On the buy side, pandemic hits, we think multiples drop 1, 2, 3, 4 times depending on the industry. The sellers look at their financial statements and their balance sheets with a much more positive eye to what's going to happen, and they justify away anything bad that happens. And so I'm not expecting, and certainly haven't in the 3 months seen on the deals that I've been part of the negotiations on, valuations dropping, you know, materially or frankly much at all, but for rescue financing. Dave, from your perspective, what are you seeing? What would you expect to see? And how do you see the valuation game playing out, you know, over the next few months?
Well, it'll be really interesting because we're a bit of a little market on our own, so who knows? But I do think what you said makes sense, is that our experience has been that sellers get favor. And so you probably are going to have to be creative in reaching that number. The most obvious way to do it probably is structure, where we had a recent experience where we took a third of the agreed upon value. We didn't change it, but we moved literally a third of it into the future. And that made people feel, on both sides, I think, feel better. And it's a way of getting the seller to really have a stake in what they are pitching you about the business. So that seems to work. I think The other thing we worry about is obviously the current financial performance is probably not indicative of what you're going to be doing in the future. So ideally, our purchase process can be stretched out a little bit, and it makes the importance of getting real-time data on the business, it makes that much more critical. So if we can get regular updates on renewals, churn, all the basic cash flow metrics, then that can be helpful in bridging these gaps.
Tom, what are your thoughts on where you think and how quickly valuations may move and abilities and methods to bridge those gaps?
Sure. You know, in my opinion, valuations are likely to go down, and it will happen, you know, over something like a 12-month period. You know, it's a fact that both from the introduction of the effects of COVID and what's going to happen with our economy in general, there's increased uncertainty. And in general, I believe increased uncertainty drives down price. And so that would be my best guess as to what's going to happen.
Joe, from your perspective, bringing back kind of historical, both PE and M&A in this space, thoughts on the valuation gap and techniques that your firm has used to bridge some of those?
I do agree that
Go ahead,
there'll
Joe.
be this difference in psychology for a while between sellers and buyers. And we saw that the last time it took kind of 12 months for sellers to really adjust to the new normal. Maybe it'll take less time this go round, but there will be a difference. And I agree with both Dave and Tom that structure is a good way to address that, either in the form of seller note or an earnout or a rollover equity. And what we've done in the past, sometimes you can't agree on the top line number in the rollover equity. You got to be creative, right? And so the amount of the rollover would vary. This is a form of an earnout, but it wasn't a cash earnout. It was how much equity the seller retained would be dependent on the performance of the business for the next year or two. So that's another way to kind of skin the cat. You know, as I said earlier, expect to have less bank debt. And if you have less bank debt, that, you know, generally means you can't pay as much. Now, searchers generally aren't paying, you know, 10 to 15 times cash flow. They're paying probably in general 6 to 9 times cash flow to buy businesses. So I would expect some kind of modest degradation, maybe a multiple point or a point and a half. But, you know, none of us, as we talked about earlier, know how long it's going to last, the recession, or how severe it's going to be. The S&P 500, if you use that as a proxy for public market valuations, which is kind of how some sellers think about the valuation of their business, it's only down 12 or 13% from the start of the year. So it's kind of bounced off the floor. We all know this, but don't expect sellers to ratchet down their expectations in the short term. And you just have to be creative about bridging the gap. We all know these businesses are worth less now, but the sellers aren't ready to believe that just yet.
Jeff, from your perspective, how do you expect this to play out?
I agree with everything people are saying and won't beat the dead horse around the conditional elements of deal structure. I don't think there's any question that every deal is going to have more structure in it, more conditional elements to try to both protect on the downside for the buyer and give the seller the potential to get what they thought the business was worth if it can perform. I think two other really important things to mention, though. One is timing. Again, you know, if you're looking at a business right now and it took a 20 or 30% hit in April, and by the way, May and June might be worse, we don't know, because, you know, we're really at the front end of seeing the impact of the last 60 plus days. It's going to be really hard to get both the banks and investors comfortable with what the business is, and where it's going to sort of bottom out and start to come back from. And I think that's going to create challenge from a timing standpoint. You may have a motivated seller that wants to close by the end of June, but you simply won't have enough visibility then. And the question will become, do you simply say, look, we need more time. You know, we're going to need to see this through the summer. We're going to need to see it through July, August, what have you. And let's plan a close in September. And what risk does that put on the deal itself? Or do you create even more structure? We've got a deal right now, again, that looks similar to what I just described. It's off. We don't think long-term there's an impairment to the industry. They believe that all the delayed work, and a lot of businesses, you know, are going through delays right now, right? Implementations are being delayed, certain work is being delayed. And they believe it's all going to happen in Q3 and Q4. We don't have visibility. We don't know. We offered to pay them on what the business has done through the end of June on a trailing 12 months basis on the same multiple, and true up at the end of the year. If that work comes back, we'll chew it up and we'll get you there. If not, and let them make the call on whether that's a risk they're willing to take. So I think I think structuring absolutely is going to be fundamental. And Joe's right. It's, you know, how creative can you get to try to bridge the gap and get both sides to a place psychologically where they're comfortable. The other thing that's going to be real is that there's just going to be less debt. You know, again, we held this webinar yesterday, and I think it's taped. So if anybody wants to listen to it, just shoot me an email or Ashley an email and we can get you a link. I believe that's right. But, you know, I think when you listen to the four lenders that we had Avid, Provident, Live Oak, and California Bank and Trust, all of whom do a lot of work with the search community. What you heard consistently from all of them was, you know, leverage levels may not drop dramatically because we're not big users of leverage. We're not borrowing 6 and 8 times like, you know, sort of the middle market. We're borrowing 2.5 times. So we may not see meaningful drops in leverage levels, but the numbers that they're lending against are going to be much more heavily scrutinized. They're not going to allow add backs and adjustments the way they have in the past. So you're just going to be borrowing off of a smaller base more often than not. Relative to what we've been able to accomplish creatively, structurally with banks in the past. So I think you're going to see lower leverage levels. There's going to be a lot more scrutiny on diligence, and banks are going to drive timelines. If you want to close, you know, by early to midsummer, assume you're going to do it without debt at this point. I think very few banks are going to be comfortable without more visibility into how these businesses are performing. And then the two other things that amongst the points that came out that really were noteworthy to me from the conversation yesterday, one, banks are going to expect much stronger balance sheets. You know, we don't know what the future looks like. We don't know if there's going to be a second wave, et cetera. And I think banks, in order to lend, are going to want to know that there's more cash available to the business to move through whatever future shocks might occur to the business on a short-term basis. So I don't think it's going to be, I think it's going to be very likely that we're going to see a higher pressure to have more cash on the balance sheet, which just means, you know, once you fix their number, probably a little bit more equity into the deal. I don't think it's a bad thing per se. And they also mentioned that there not only will be more scrutiny and diligence, but banks have been very lenient. I think all of us have experienced this with our portfolios, reasonably lenient with portfolio companies because the nature of this shock was so unforeseen that, you know, if we need to have, you know, some holiday on principal payments, interest payments, covenant relief, what have you, they've been willing to engage in those conversations. What we heard from all four lenders yesterday was, if a loan is written in this environment, the expectation of the credit committee is that we have enough knowledge that we shouldn't have a problem, or we underwrote really poorly, and they think there's going to be less leniency on loans that struggle that are done in this environment. So I think that will put another incremental layer of conservatism into the capital structure on the short-term basis.
Great. GJ, any thoughts? I know we've covered a lot here on the valuation and structure game in terms of getting buyers and sellers on the same page.
Sure. I mean, maybe as the least qualified and least experienced, I'll caveat my comment with that. But I'll maybe take a slightly contrarian take. So I think the challenge as a searcher right now is we're telling you to look at really good businesses. So a business that's performing well right now, I'm not sure you're going to see a lot of valuation change in the near term. And there's going to be a flight to quality. And we're seeing that in our space right now. There is a lot of capital out there. So if you're looking at a business right now that's doing well and you have a willing seller, it's going to be hard to convince them to sell for a lower price, right? I mean, the public markets are such a strange thing right now. The public comps are actually higher than they were 6 months ago in many industries. When you actually look at the markets, now who knows what the public markets do going forward, as we all know. But so I think there's a little bit of, I think we're going to have to see structure. I think we all should be studying up on seller financing. When we did our search, there were no search fund lenders. Those 4 names that Jeff just rattled off, like they didn't exist in our world, right? It was all seller financing. Maybe you got lucky with a local bank, earnouts. So I think all the structure things we're talking about, but I think you will see more seller financing. It's going to have to happen to kind of bridge some of these valuation gaps. But and look, and we're a bit contrarian. Look, we probably overpaid 2 or 3 turns for our business, but it was an incredible industry and it didn't matter in the end. I'm not encouraging everyone to go out and overpay for a business by any means, but I think also be careful not trying to like bottom out the market here, because if you've got a good business, it's going to be hard to get them to trade at a materially different price than they were 6 or 12 months ago. That's just the world we're in right now.
Yeah, and look, I'm seeing that, and I have to say, from a deal structure perspective, I think it's, if we're going to flee to quality, I think people have to accept the fact that they're not going to see big downturns in valuations, and you're going to have to come up with a creative way to bridge those differences. And some of those differences may actually be the view of valuations of your investor group. And one of the things that I want to make sure everyone out there who is in the searching process right now thinks about and focuses on as we talk about these various issues. And it's something that's near and dear to my heart, that those of you that I work with closely on the searcher side know that when you're creating your investor syndicate at the front end, one of the things that I always recommend and caution is that you carefully pick that investor group. And I think this is a time where, as a searcher and an entrepreneur, you want to be as close to your investor group as possible and work with that trust and goodwill that you've already established with them to talk through issues that come up with, whether it's the life of the fund or timelines on an acquisition. I'll give you a perfect example. We closed a deal about 3 weeks ago where the entrepreneur / searcher went to the investor group, and we had a specific decision to make. We were worried that the seller psychology was changing, went from wanting to sell immediately, flip-flopping to maybe I'll hold, maybe I'll do this. And we actually moved closing up 3 weeks. This was back in early April. We moved closing up and got the investors on board with that in order to not lose the deal. There were part of the investor group wanted to wait. Another part of the investor group said, let's go now. And in fact, we were able to negotiate a price concession, disguised as an earnout in order to get that deal done early. And so I think it's really important that as you think through these various issues that we've talked about during this program, you not think through them on your own, because your investor group and the folks that you've become close to are critical assets to you. And when I said, 6 months ago, 3 months ago, a year ago, when you were creating your fund, pick your partners wisely, because they're going to be your partners for the next 7 to 10 years. These are the types of circumstances where you need to use that asset, because the people that are invested in you have been through this. Obviously, none of us have been through literally this event, but we've been through other cycles. And don't be afraid, just like you're building relationships with sellers, to build and maximize those relationships with the investors and use them as a resource to figure out where your next few months is going to take you. So panelists, thank you very much for this discussion. I'm going to give a little brief public service announcement on the CARES Act and PPP loans. As you're looking at targets, all of you should be aware that if your target has taken out a PPP loan, you need to factor it into the acquisition, and make sure that you talk to your counsel that is helping you with the acquisition to think through the long-term implications of your target having taken out a PPP loan, so that it is becoming standard course now in M&A deals that there will be representations of warranties and indemnification associated with those loans. So if they were improperly obtained or the proceeds were used incorrectly, think of it as you're going to be looking at an indemnity for a 7-year period. We're going to be asking for that on the buy side, and then when you're in the sell side, you're going to be dealing with that. So handle that very carefully. What I'd like to do before going into the Q&A, and I've got a series of questions I'll answer for the group, is to give each of our panelists an opportunity for some parting thoughts on some of the questions we covered and possibly other topics we didn't. So Jeff, I'll go to you first to kind of sum up your thoughts.
most of you guys or gals have heard me say this in the past. You know, entrepreneurs are oriented toward taking action, and it's one of the greatest assets that all of us bring to the table is we're driven to actually do things rather than sit on the side and watch. With that orientation, I think it's really tough to sit and listen to any messaging that says your path may be delayed. It's just not consistent with the psychology that you're bringing to the table. And I get that. I've lived it. We've all lived it. I want to say in my parting message to you, there are going to be challenges in the short run. You've heard a lot of it today over the last hour plus. But the silver lining here is way more than just some token words that are positive to try to make you feel better. The silver lining is the market sometime in the next 12 to 18 months actually should be the optimal time for you to pursue your dream. I really believe that. I've watched it, I've lived it. And I think that, you know, if you can get yourself mentally past the front end of this process, you are going to be really happy that you're searching right now. For those of you that we're partnered with, we are incredibly excited to continue this journey with you and support you and find ways to get into great businesses together. So, you know, take a long-term view. We always say it's a marathon, not a sprint. That is more so true than ever now. And you're going to be happier in the market if you can get there.
Dave?
So I just have a couple of thoughts. One regarding the 08-09 experience. We actually, if you look at the businesses we invested in 08 and 09, compared to the recovery in 2010, we actually had a better ratio of winners versus losers in the 08-09 timeframe. So I don't know what that says about today's environment, but I think it does say that we were really focused on quality in that time frame. And so I think there are potentially deals to be done out there, but clearly there's going to be an emphasis on quality, especially when it comes to projecting those future cash flows. I would definitely like to reinforce what Alex said. I think it's super important to stay close to your investors, keep those relationships going. And my final thought is, I'm totally impressed with the interactions we're having these days with searchers. Terrific interest, very creative, very optimistic, and I hope you keep that optimism going. And we really appreciate the effort you guys are all putting forth.
Tom?
I think COVID-19 is a once in a generation economic disruption. And I think history has shown that big disruptions lead to big opportunities for those that are ready to kind of take advantage of those opportunities. And so I'm actually personally very optimistic about the searcher environment for the next couple of years. And so we're looking forward to partnering with a lot of great searchers over that time.
Joe?
You know, be thoughtful about your industry selection. I would focus on industries that can operate remotely and those that can deliver their services remotely, because that's the world we live in for the time being. And there may be a second round of the virus later this year. We don't know. But otherwise, don't become too discouraged. You've got to, you know, you're all smart, creative people, and your investors are, you know, want to see you succeed. So it may take longer, but don't give up, and we're behind you.
GJ is the voice of optimism in the group. I've actually heard more optimism for the first four than I expected. So you've got a hard act to follow now.
Wow, a lot of pressure. Well, maybe I'll start by quoting the legendary philosopher Mike Tyson, who I think has commonly said everyone has a plan until you get punched in the face. And look, we all just got punched in the face by COVID. I don't think Alex Temmel had in any of your PPMs the global pandemic risk factor. I was looking through a few of those and didn't seem to pop out there. So look, no one saw this coming. We all just got punched in the face. But look, as almost everyone's echoed, you're in round one of a 12-round fight here as a searcher, right? When you're in the search, look, it is a daunting experience. It was the most stressful experience of my life. It was brutal, right? It is hard, but it's actually only the beginning of this incredible journey that you're on right now. And if you can just keep that perspective, as others have mentioned, I think that's just extremely important. And then the other thing I've been catching up on like many of you, a lot of the classic sports available without the live sports. So between The Last Dance and some of the old Yankees, I actually came across another interesting quote. I know many of you are probably familiar with Lefty Gomez, an all-star Yankees player, I believe, the 1930s. So maybe a little, well, I don't know, maybe a few of you on the panel, but no, just kidding. I don't think anyone is familiar with the Lefty Gomez. But I think he most legendary said, "I'd rather be lucky than right," you know, a Hall of Fame baseball player. And look, I think one thing Will and I have taken from our experience is we got extremely lucky on timing. Look, we bought a business in 2011. We sold in 2018. We were extremely fortunate to have an outsized outcome, had incredible investors, many of who are here today. But look, luck matters in this, and that's a brutal thing for us all to kind of process. We're all extremely high driven and want to kind of manufacture every part of our lives, but luck matters and has a huge influence on all of our outcomes. And you now have a chance to get extremely lucky. I know that maybe doesn't feel great right now, but you have a chance, as many have echoed, to perhaps buy a business, come out of this, and catch the next economic boom. And look, that matters. You know, it matters a ton. And you now have a chance. I think it's an incredible opportunity. I would say, and I mean this genuinely, I believe there will be many or a handful of you on this session today that ultimately will have some of the top 10 outcomes ever in search fund history. There will be multiple of you here that have incredible outcomes that come out of this. It'll be a brutal experience the next year or two. I'm not trying to downplay that. It's going to be a grind. It's going to be a hustle. But there is a rainbow, I think, out there. I think we all should be looking forward. I know it's really hard, but if you can just think about the future, I think this could actually be the best thing ever happen as far as timing for you, but it's going to be rough in the near term.
Thank you very much. I received a few questions that I think I'm going to bounce off the group, and whoever wants to provide some insight, that would be appreciated. Going back to the topic of seller psychology, question, is there ever a bad time to reach out to owners? And the concern and the background on the question is, right now, as many people are struggling and a lot of these businesses are struggling, is there a concern that we would be perceived as vultures trying to reach out at the worst time? And because of that, is there a reason to potentially wait I'm going to preface the answer where I think most of you are going to go. In lieu of waiting, is there a better or worse way that you've seen to approach owners during sensitive times?
I think the answer is very different now than it was 2 months ago. Certainly talking to a lot of searchers that we have very high frequency recurring calls with, as well as just our own experience internally. In the second half of March, there was a tremendous amount of negative backlash and feedback to outreach. It was just not the time to be talking to people. And we heard a lot of stories, a lot of anecdotal stories about, business owners just shredding communications coming to them. I don't hear nearly as much of that now. Outreach is definitely, I think, more limited for most searchers. They're not pumping out thousands of new contacts a month. They might be doing it in 10s and 20s and 50s. But I have not heard nearly as much backlash. I think that there are plenty of owners, and the majority of the feedback that I'm getting is plenty of owners who are saying now's not the time, but happy to connect later. That's very different than you're a jerk.
I agree. I think that it may be hard because there may be owners that are pretty distracted by what's going on right now. So it may be hard to get some owners' attention. I think there are other owners that are looking for help, and if you approach them as a potential partner and a solution for giving them a chance to kind of diversify their own personal net worth, I think you can be welcomed.
Another question that I got, which is actually I'm going to provide a little insight on, is in the context of deal sourcing, how do we feel about, given limited travel and the ability to go meet people in person, the use of Zoom calls and other related means of communicating with people, and will it be viewed as a negative? It's actually an interesting question. I can tell you I've had many conversations about this with investors across the spectrum. The irony is, I do think our world has changed in that way. While by definition we can't travel the same way we could before, I think on a go forward basis, doing Zoom calls and other types of non-in-person communications actually become much more accepted. It was viewed historically, at least in the private equity and M&A space, that if you didn't go visit somebody in person, you were slighting them, or it wasn't a priority, or it wasn't an interest. That has definitively changed. And while person-to-person conversations are very different and in many ways really important, and one of the things that I've given guidance to entrepreneurs when closing a deal and there are difficult issues, to try and sit across the table from the other side and read their body language to figure out what is posture, what is legitimate, what isn't. But my own guidance to all of you is, on your outreach, do the best you can. And a Zoom call is not viewed as a negative at this point. It's actually become standard course. As many of you know, I literally probably do 10 to 12 a day, all different contexts, from negotiations to events like this. But the world is just different because we can't travel. And I do think as things start to open up, rushing out and meeting somebody in person isn't always going to be the best outcome. What you have to realize is everybody on the sell side is going, just like on the buy side and the investor side, is reacting to this differently. They may not want to sit in the same room as you, for better or for worse. They may be happy to take your check and take the investors, but don't presume everybody wants a face-to-face meeting. And so, have any of the panelists come across, or given any thoughts to how this process may change going forward?
Well, I agree. I think it is a new world. And, a Zoom call is incredibly efficient. To go visit a potential, acquisition, probably takes a couple of days, versus you can have, you can do that in a fraction of that time. And so I think it gives, a more chance for you to meet a wider variety of potential sellers.
Yeah, Alex, I think one interesting question, I agree with you and Tom, that in the current environment, getting a conversation started by any means possible is worthwhile. But are we going to be willing to close deals without ever having seen the company physically?
We're having to make hiring decisions based on that exact question as well. So
Tough.
I think we're all going to
Really
be
tough.
faced with, and honestly, I think the true answer is none of us know. It's really going to depend on how the next 3 to 6 months, maybe if we had Fauci come and give us a little speech, he'd tell us, you're going to have to get used to buying sight unseen. If we had some other people, they may say something different. But the reality is, at the front end, I encourage everybody to use whatever source of communication and outreach that you have. One last question, and I know our time is running up. For those of you who have made international investments and or think about that arena, how has the COVID-19 situation changed your outlook or view of transactions? The one insight that I can give, and as many of you know, I probably have 20 plus searchers that are searching internationally. It's just slow, and it's going to be it's always a slower process to begin with, but it's going to be even slower now. And I think the big issues that you're going to have to face are the same ones: the ability to achieve leverage, and then also how you handle exchange rate risk, because of the amount of fluctuations right now. It seems like on a weekly basis, currencies are moving all over the place. But for the panelists who do have international experience, any thoughts on how this will impact things? So I'm going to go with silence, actually, as more of an issue of we are running out of time. So we're about to be disconnected in about 30 seconds. So I want to thank everybody, and especially the panelists. Really appreciate you volunteering for what was supposed to be 15 to 18 people, turned out to be 180 plus. Really appreciate the time, and to everybody who participated and dialed in. feel free to reach out to any and all of us with follow-up questions or concerns, or if there's additional learning that may be worthwhile. One of the things about this community that has always impressed me, and the reason why I dedicate so much of my personal time to it, is it's a very different world than the private equity one. And I am always stunned, happily so, how much this entire group of entrepreneurs and investors are willing to share best practices and thoughts. This is not the type of roundtable that honestly could happen in a private equity community. What differentiates this group from the other investment sectors is the willingness and openness to work together and come up with best practices. So all panelists, thank you so much for doing this, and everybody who participated and dialed in, really appreciate the support. And April and Search Fund Alliance, Hal and MK, assuming we haven't put you to sleep, thank you very much for organizing this, and look forward to eventually seeing everybody in person, whether it's at the next annual meeting or the next roundtable that we do via Zoom. So thank you very much, everyone.
Thanks, Alex. Terrific job.
Thank you, Alex. Great job leading it.
Nice job. Thanks, Alex.
Thanks. Have a great afternoon, everyone.
All right.
Stay
Take care.
safe.